The waiver of premium rider is a critical component for the national portion of the life insurance exam because it serves as a safety net if the insured becomes totally disabled and is unable to work. You should think of this rider as an insurance policy for your insurance policy. On the exam, you will likely see a scenario where a policy owner is suddenly incapacitated. The core function of this rider is that the insurance company will waive the premium payments to prevent the policy from lapsing during that period of disability. One of the most important technical details you must memorize for the exam is the waiting period. Almost every waiver of premium rider includes a 6-month waiting period. This is a favorite subject for examiners because it involves a timing trick. During these first 6 months of disability, the policy owner must continue to pay the premiums to keep the coverage in force. If the disability continues past the 6-month mark, the insurance company begins waiving the premiums moving forward. But here is the part that often shows up as a correct answer choice. The company will also refund all the premiums the insured paid during that initial 6-month waiting period. The exam will frequently try to trick you regarding the internal growth of the policy. They might suggest that because the insured is not paying, the cash value stops growing or the dividends are suspended. This is false. From the perspective of the growth of the policy, it is as if the premiums were being paid by the insured. The cash value continues to accumulate according to the schedule, and if the policy is participating, dividends are still declared and paid. The death benefit also remains untouched. The company does not deduct the waived premiums from the eventual payout to the beneficiary. Another area where students get tripped up is the age requirement. The waiver of premium rider does not last forever. It typically expires when the insured reaches age 60 or 65. If the insured becomes disabled after this age, the rider provides no benefit. On the exam, pay close attention to the age of the individual in the word problem. If they are 67 and the policy has a standard waiver rider, the answer is likely that the premium will not be waived because the rider has already expired. You also need to be clear on the definition of disability used in these questions. The rider requires a total disability and not a partial one. If a question states that an insured can still work part-time or perform some duties of their job, the rider typically will not trigger. Most policies define total disability as the inability to perform the duties of any occupation for which the person is reasonably suited by education, training, or experience, although some may use an own occupation definition for the first couple of years. A helpful phrase to remember is the 6-month wait to waive. This helps you recall the 6-month waiting period required before the waiver and the retroactive refund take effect. When looking at different policy types, remember that while this is common on whole life and term insurance, it looks a little different on universal life. In universal life policies, which are flexible, this rider is often called a waiver of monthly deductions or waiver of cost of insurance. Instead of waiving a fixed premium, it waives the actual mortality charges and administrative fees that are taken out of the cash account each month. However, for the general national exam, the primary focus is on the standard waiver of premium found in whole life. In terms of recovery, the exam might ask what happens if an insured person who is utilizing the waiver suddenly gets better and returns to work. In this case, the insured simply resumes paying the premiums. There is no debt created and no requirement to pay back the insurance company for the months or years they covered the cost. Furthermore, consider the underwriting for this rider. Since it provides a significant financial benefit, the insurance company will charge an extra premium for adding it to the policy. This extra cost does not go toward the cash value. It is strictly the price of the rider itself. If the rider expires at age 65, the overall premium of the policy will typically decrease because the charge for the rider is removed. Pay attention to questions asking about the net effect on the premium once the rider drops off, because that is a common way to test your understanding of how riders are funded.